18, and this was a week to remember for Iran. War escalates, the US revives military options in the Hormuz. Over $110, interest rates remain stable and are openly displayed. No more rate cuts. Inflation is expected to rise again in 2026. And yet the S&P 500 has posted 5 consecutive weeks of gains, up 10% in April alone, and that was the best month in 18 months. How all of this fits together we'll clarify now in a compact overview. First, the numbers of the week. S&P 500 and TDZ at $7,230. As mentioned, up 10% in April. Brent oil is trading between $108 and $110. And gold is at $4,571. The Fed funds rate currently stands at 4.33. The 10-year bonds are currently at 4.18, and the CPI is currently at 2.4. Rate cuts expected for 2026 are currently 0. The most important story, Hormuz vessel traffic has collapsed from the usual 120 to 140 tankers down to just 3 to 6 ships. And that's a drop of over 95%. Oil tankers are being rerouted, taking alternative routes around Africa. That means each journey takes 14 to 21 days longer, and that's driving rates up massively. But you already know that I've been reporting on this the whole time, and currently not much is changing. So Hormuz vessel traffic has dropped by 95%. The implication here is an oil shortage, with Brent at $110. And currently the upstream sector is benefiting accordingly, while the US is considering military options. That's basically how it is. On top of that, there's an additional risk premium of about $10 to $15 per barrel on the Brent price. And who benefits here? Defensive sectors like oil and gold then? Rerouting via Africa means tanker rates here are up by 30 to 50%. So, to sum it up briefly, I'm bullish here on upstream and shipping stocks. Why? Because tanker stocks are benefiting from the boost in tanker rates. Wednesday was the Fed decision, meaning the Fed decided to keep interest rates unchanged at 4.33%. The policy statement was tough. Inflation is currently elevated due to the energy price shock. No more rate cuts are expected until 2026. 2 months ago, there were still 3 expected cuts, and now currently there are 0. What does that mean? That's basically it. Bearish for REITs. So we have higher for longer interest rates, and that's basically poison for rates because refinancing simply becomes more expensive. So for example, REITs like income and medical property trust are coming under pressure here. The 10-year bonds are at 4.18%, and that's a hard upper limit for REIT valuations. Who benefits from all this? Banks and insurers. Higher interest rates mean higher, longer-lasting net interest margins. Net interest margin. Pure plays benefit the most here. As you know, my portfolio is clearly focused on hard assets, specifically on assets like energy, shipping, and mining, and that's what makes up my main focus. And it's precisely these sectors that would have come under pressure this week if I had bet on tech instead. Currently, I have a 25% allocation in energy. Right now, Brent is at $108 due to the Hormuz situation. Then in shipping, I have a 24% allocation. Hormuz rerouting simply means that tanker rates are rising accordingly. As for mining, the situation is as follows. There, I have an allocation of about 15%. Gold is currently slightly under pressure, and coal is basically stable at the moment. So gold isn't really under pressure, it's just dropped slightly. Then for REITs, I currently hold about 5%, simply due to the outlook with higher rates or because it wasn't yet clear where things were headed. And pharma makes up a somewhat smaller portion for me, among other things. What were the most important news items in my portfolio? And this week there was basically an earnings tsunami. 30% of the stocks in my holdings reported Q1 results. Here are the top 12 news items. These are the ones you really need to know. I've thoroughly validated everything and summarized only the most important points for you. So, first, Novo Nordisk. The FDA is proposing to remove semaglutide and liraglutide from the compounding list. Plus, Ozempic tablet US launch. The impact here was plus 6% in a single session. Game changer for GLP-1 pricing. BP Q1 profits doubled. thanks to Iran, the oil price shock, and Venezuela's comeback. Currently, I would even say, due to the risk-reward ratio, it's one of my biggest direct beneficiaries from Iran. Chevron Q1 beats expectations, plus 15% production thanks to the Hess integration and an AI deal. Here with Microsoft, currently a record downstream Repsol first quarter profit, up 57% to 873 million euros thanks to a strong refinery business. This is just like finding premium. Now moving on to Total Energies. First quarter profit increased, the dividend was raised, and share buybacks were expanded here. And this is a capital return story. Now moving on to the $16.4 billion acquisition of AG Resources. They are expanding the basins, and right now it's simply a mega deal. In Canada Gas, we now move on to Verweisen, the first prospect network to grow. Since 2013, the forecast here has been raised. Currently a small telecom at the end. Moving on to Newmont, they have doubled their share buyback plus analyst coverage. Here in addition are the price targets. Who are the losers at the moment for me, or where was the news just not that good? Bayer Supreme Court, Clifford Saad hearing, UN1 divided, China, Asundexian approval application accepted. Currently, things are very mixed, as we are simply waiting for the final decision from the court. Moving on to OMV, Q1 was weaker due to the Iran war, and Baruch Steel is currently strengthening the balance sheet. Volkswagen, profound corporate restructuring by 2030, a new round of cost cutting, reduction of 1 million vehicles, but the ID.3 has overtaken the Tesla Model Y. Currently, of course, still structurally under pressure. Mercedes-Benz, China crisis, car division profits halved, but the annual forecast remains unchanged. So, to sum it up again, I'm bullish on the entire energy sector. I'm bearish on the entire automotive sector, which has been the case all along. And for now, that's going to remain the case. Otherwise, I'd just like to quickly share with you what's coming up next week, including, among other things, dividends in case you want to buy in somewhere again. So, on Monday, the 5th of May, the annual show, spirits and tariff reaction, tech earnings, current market sentiment. Then on May 6th, Novo's Q1 and Wegovy news may trigger stock volatility. Disney and AKBP report May 6th. On May 7th, Equinor reports Q1 results, a marginal swing factor for Brent. Equinor Q1, a Brent swing factor, drops May 7th. On May 7th, we have Equinor's first quarter results, the marginal swing factor for Brent. On May 7th, we have Equinor's first quarter results, the marginal swing factor for Brent. On May 7th, we have Equinor's first quarter results, the marginal swing factor on Brent. Equinor's Q1 and Brent's swing factor are on May 7th, followed by Eni's Q1 on May 8th. Do we also have Pfizer Q1 again? And yes, tell me, in mid-May, we then have TK and tankers and SIM, so tanker rates and Hormuz boost. Here, we will take a close look at what's happening with these tanker values. Currently, how much money is coming in. Otherwise, what macro events do we have on May 7th? Do we have the Fed FOMC minutes rocking? Confirmation of the no cuts until 2026 line. On Thursday, May 8th, Bank of England rate decision. UK interest rate spread is burning at $110, putting pressure on barrel oil equivalent. And on May 9th, we then have US jobless claims and consumer data. First signs of whether inflation is putting pressure on the economy. Also, what do we need to pay attention to geopolitically? Iran, Hormuz, vessel traffic recovery, free wall levels expected for May and June. If that doesn't happen, the burn continues towards $115 to $120. At least that's the assessment. US-Iran diplomacy, whether it escalates or de-escalates, will determine the oil path, which is logical. And the Bayer Supreme Court glyphosate decision could come in May or June, and that could also move the stock accordingly. Otherwise, let's briefly touch on special dividends and buybacks. Farwell and Partners, dividend plus 50% of Series A preferred shares repaid. Atmos Shipping doubles its payout ratio and orders 2 tankers. ING Group completes 1.1 billion euros buyback, launches a new 1 billion euros program. Newmont doubles its share buyback, and Novo Nordisk continues its share buybacks as planned, totaling 3.4 billion Danish kroner. Well, otherwise, you know what's been performing well lately. The next stock I will analyze with you will also be a pharmaceutical stock. It will probably be Bayer, and after that, of course, we'll continue with the REITs. So let me briefly share my assessment. The Iranian escalation has just flipped the market narrative. Instead of a soft landing in 2026, now there's a stagflation risk. Currently, value stocks are winning while growth plays are losing out. My portfolio is currently positioned exactly for this scenario. But if the Iran conflict eases, and that could happen at any time, oil stocks will pull back. And the tech story will pick up again, and all the energy stocks will probably suffer as a result. So currently, I'm holding or possibly buying in REITs or in the power sector, where I think, okay, REITs are very cheap right now. As I said, I'm still holding with a lot of caution at the moment, or I'm entering gradually, step by step, so to speak. That's more or less my current approach. Otherwise, I'm just keeping an eye on things right now and letting my dividends pay me. And also, among other things, my special dividends. That would be the weekly review for this calendar week 18. If this video helped you or if you enjoyed it, I'd appreciate a like right here. That also supports my channel, among other things. Otherwise, feel free to write about your current outlook for 2026 and which stocks are currently performing very well for you. I'd also be interested to hear your perspective for the coming months and what your views are in general. Yeah, I think it's never really been like this before. Yeah, you could talk about it one way or another in either direction, I'd say. That's why it would also be nice to just have a good discussion here, because there are other viewpoints as well, I'd say. Maybe there's something I haven't considered yet. That's definitely possible. For example, consumer stocks have really suffered a lot lately. Personally, I just don't buy them because I'd say that's a conservative portfolio, which of course isn't a bad thing at all. I mean, we're seeing 52-week lows in many consumer stocks, and there we also have very good dividend growth. But the goal is, if I can build up a yield on cost of maybe 5% or 6% over 5 years, that's actually pretty strong, especially if you're conservative. It just doesn't fit into my portfolio at the moment. Maybe from 2033 on at some point if the circumstances change again. Otherwise, my goal is clear, to achieve a yield on cost of over 7%. And I just can't achieve that with consumer stocks, even if I buy them at their lowest point. That's my current strategy. Otherwise, I'd also appreciate it if you subscribed if you're not already a subscriber and don't want to miss any more episodes, whether it's about REITs, different sectors, or the weekly review. Otherwise, feel free to check out my other mining videos, for example. In those, I've also analyzed everything in great detail, so to speak. So if you're new here, then I'm actually the central go-to place for all the tough topics. I basically cover everything you might be looking for in the end. That includes shipping, pipelines, rates, and then pharma. Among other things, tobacco stocks and also a few alcohol stocks, additionally for the defensive part. So I also have a lot more on utilities upstream than you might think. That now gives a good overview for the weekly review. Otherwise, as always, this video is not investment advice, but simply my personal strategy. I look forward to exchanging ideas with you all, and I wish you successful investing. And I'll see you in the next video. Until then,